Hello, welcome to BST Live, the show for systematic and algorithmic traders. Glad you could join us today, where we're going to be talking about volatility and how we can use volatility to outperform the market. And our special guest for today is Kyle Schultz from Algorithmic Futures. Welcome, Kyle. Glad you could join us today.
Yeah, thanks for having me, Andrew. I'm looking forward to the discussion.
Right. So where are you coming from today? Whereabouts in the States are you?
Yeah, I'm in Los Angeles. So I've been out in LA for about 8 years now. Originally from Chicago, though, and went to business school at UCLA. So once I was out here, hard to go back to the harsh winters of Chicago.
Yeah, I bet. So let's dig a little bit more into your background. As I mentioned, we're going to be talking about volatility, and as I was speaking to you before this call, you seem to have a lot of knowledge about volatility. So I'm glad that we're going to be digging into that a lot deeper today. But before we get to that, how about can you give us a little bit of background on yourself, how you got started in trading?
Yeah, absolutely. So I mentioned, I'm originally from Chicago, and Chicago has such a vibrant trading scene, given the CME and the CBOE and the exchanges there. So there's, probably 50 to 100 prop trading firms, and it's just a really good community. My brother's friends worked at different prop trading firms, and I saw them. They were doing very well, and left work at 3 p.m. and worked for themselves. And I said, wow, that seems like the dream job. I want to do that. And went to undergrad at University of Iowa. And when I graduated, it was 2008, right? So it was a time when those prop trading firms, they weren't looking for traders anymore. They were looking for programmers. Everything was moving systematic. And I just didn't have that skill set. So I ended up taking a job at an investment consulting firm, and then I did hedge fund manager research for a very large insurance company. So that's how I cut my teeth in the industry. And I was interviewing large hedge funds like AQR, Brevin Howard, and just kind of soaking up all that knowledge. And that's where I kind of cut my teeth. But I always wanted to be closer to managing the money. So I went back to business school to UCLA. That's what brought me to LA. And started learning programming from some of my data analytics classes. So I'd start to backtest different trading ideas in R and Python. And then I had a stint in equity research and a stint in private equity. I did that for a couple of years, but couldn't get rid of the trading bug, right? So, started my CTA, Rovinia Investment Management, and then I started Algorithmic Futures in early 2019.
Right. Okay. So, can you give us a little bit more insight into the styles of trading that you do and the markets that you prefer to trade?
Yeah. So, my trading journey, I've explored so many different styles and strategies, right? Everything from option spreads on equity index futures, options on stocks, commodity trend following, mean reversion pair trading. But ultimately now I'm focused on intraday and short-term mean reversion and momentum strategies in equity index futures, treasury futures, and currency futures. So that's kind of my primary focus right now, and that's how I've developed the portfolios at Algorithmic Futures to create diversified portfolios using these strategies.
Yeah. So why did you pick those markets in particular?
Yeah, that's a good question. I started off my CTA trading relative value strategies and volatility futures. So calendar spreads on VIX futures, iron condor option spreads, which is a four-legged option spread. And these strategies were good, but I knew I needed to beef up the portfolio and add some long vol exposure to the portfolio. And long vol strategies are the holy grail of trading, right? Because you can significantly outperform during periods of market crisis events. So during my research, I actually found out that the best long vol strategies are actually not through trading VIX futures. It's by trading breakout and intraday momentum strategies in equity index futures. So, there's that old adage, the market takes the escalator up and the elevator down, right? So we have pretty violent down markets, and that's where intraday momentum strategies can really outperform. So it was kind of a long journey in exploration, but ultimately, I wanted to create a portfolio that could outperform in market crisis events, but also had some mean reverting strategies that would perform out in markets like we're seeing in 2021. Intraday momentum strategies, as we were talking about, did very well last year, but creating a diversified portfolio so that you can outperform no matter what market environment you're in, that's essentially what the goal is at Algorithmic Futures.
Yeah.
Yeah.
So was that one of the key drivers in the reason why you include volatility as such a main component in your trading, or were there other things there as well that kind of directed you to that focus?
Yeah. So, I think whether you're trading volatility or not, you have to look at your portfolio and your trading strategies and bucket them either into long vol or short vol, right? Because at the end of the day, your strategies are either going to underperform or outperform during market crisis events. And, 80% of the time we're in a bull market. So I'm not saying you shouldn't have short vol strategies. Those are important in the portfolio as well. But if you're overexposed to short vol, say you're an option seller, you're going to get crushed in 2008 vol events, COVID in March and April of last year. So I look at the portfolio and say, okay, if I'm trading 10 different strategies, how many are short vol? How many are long vol? How do they fit together through correlation analysis? And how do you really construct a robust portfolio by doing that?
Yeah. So you just mentioned 2008 there as an example of what can happen. Do you have any other insights from history that kind of we can learn from as far as volatility?
Yeah, I think there's been, first of all, you have to categorize volatility events. Each volatility event's unique and different, right? So in 2008, we're in a 1 to 2 year bear market. Same with the tech bubble in 2001 to 2002. And then you also have very violent one-day drops like the flash crash or the 87 Black Monday market crash. And then you have more frequent moderate vol events, which are 10% corrections, right? So understanding how your strategies perform in each of those volatility events is important. You can't just, there's no one size fits all, like this is a long vol strategy and it catches every vol event, right? So looking back at history, some people may remember volmageddon, which was February 5th, 2018. And so I don't know if you remember what happened in the market, but the VIX actually spiked from 18 to 37. And you might say, well, that's, VIX got up to 90 during 2008. But the big takeaway from that is that's over 100% spike. And over the previous 5 years, from 2013 to 2018, you had all these short volatility sellers piling into XIV and SVXY, the inverse VIX ETFs, which were billions of dollars. And essentially, that was up 500%. And then in one day, those ETFs capitulated because VIX spiked 100%. And, all these easy money traders that were making a lot of money got wiped out. And you can look at the Reddit threads. I think a lot of people had a tough time. Even a lot of large managers, like there was one CTA, LJM Partners, which was $1 billion CTA that was selling options. They got wiped out during Volmageddon. So it's an important lesson. It's like that event didn't happen historically, right? We never had this extremely, extremely low vol environment from QE, endless QE, where the VIX was trading below 15, most of 2017. And then even a small spike can do a lot of damage. And that's what we saw. So the lesson is know your short vol exposure and really understand how your strategies perform during every vol event that you can look at.
Yeah. Okay, that's a good example. So thanks for sharing that one, Kyle. So I can see in the chat there are people asking already how you apply volatility in your strategies. So how about we get a little bit more practical now? How do you actually apply them in your strategies? Do you build strategies with a specific environment in mind, or do you apply it later, or how do you fit volatility into the process of building strategies?
Yeah, so there's many ways actually. I mean, the first is you can use the VIX index or the VIX term structure as a signal. So I have, strategies that do that. But I think more prevalent is using volatility regimes in your trading strategies. So if you develop a strategy and you're back testing it, and you're looking historically and you see that the performance is bifurcated during different market volatility events, you might use a volatility filter, right? And that could be based on the VIX index, or it can be based on some of the futures if there's too much noise in the VIX index, right? Another important example is adapting your take profits and stop losses depending on the volatility environment. So, you might have tighter profits and stops during low vol environments, but you want to expand those during high vol environments so you're not constantly getting stopped out. The market's swinging more, and you really have to kind of expand where the profit targets and stop losses are in order to have a strategy that's right sized for the volatility environment that you're in.
Yeah. So if you were to apply volatility as a filter, would you do that at the beginning of the process or at the end? Why would you do it like that?
Yeah, typically it's going to be at the end because I want to look at the back test and understand how the performance of the strategy looks. And, if I can make that inference that I notice different types of performance during different vol events, then, I can start examining and looking at different, I might look at, okay, how does this strategy perform if the VIX is above 40 or below 40, right? Because you want to use a number where there's not too much noise in it, or you might adjust your profit target and stops based on where the volatility level, where the VIX index is at. So it can be pretty, it can enhance your strategies pretty significantly.
Yeah. So what if you do that analysis? So you've built your strategy, and then you're applying the volatility filter to see how the strategy performs in different regimes. What if you identify that there is a particular regime where the strategy is really, really poor? How would you manage it then? Because you've got options like you can switch it off, or as you mentioned just a moment ago, adjusting stops and exits. What do you do? How do you manage that when you've identified a environment where the strategy doesn't work so well?
Yeah, I think you can, like you said, you could use dynamic position sizing to kind of lower the amount of exposure you're trading in a volatility environment where the strategy might not perform well, right? So if you have intraday momentum strategies that do very well during trending and momentous markets and high volatility, but they don't do well during choppy, mean reverting markets, you can adjust the position sizing or even turn them off, right? But ultimately, if you create a diversified portfolio of both mean reverting and momentum strategies, you can use some of that, but sometimes you just need to diversify away that risk with other strategies, right? Because you want to avoid overfitting, of course, and then you can't really create a strategy that's going to outperform in every single market environment. So you'll overfit your models if you do have something like that. And sometimes it's better just to leave it alone, let it trade, reduce exposure, but use other types of strategies that are uncorrelated.
Yeah. There's a question in the chat here. I just want to put it up on the screen from Dr. Amir. What type of volatility filters are we talking about here?
So usually when I'm talking about volatility futures, volatility filters.
Yeah.
Filters, we're essentially looking at categorizing what VIX regime we're in right now. So you might filter and say, okay, if the VIX is under 20 and we're in a low volatility environment, increase position sizing to these strategies because they tend to perform better in low vol. If VIX is between 20 and 40, you're probably in some pretty choppy markets. So maybe some mean reversion strategies that perform well in choppy markets might work well. And then if you're above 40, you're probably in a pretty high vol environment where momentum strategies might perform well. So maybe you'll increase position sizing there. So it's really laying on top a filter to categorize how the strategy performs in each of those types of regimes.
Yeah. Okay. We've got a question here from SL. This SL stole my next question. Let's put it up on the screen. Thanks, SL. Other than VIX, what is your favorite indicator to measure volatility of markets and stocks, such as ATR, standard deviation, or something else?
So I use a lot of times VIX term structure. Like I mentioned, VIX can have a lot of noise in it. So it can create a whipsaw effect. But if you use first month, second month, third month VIX futures, they move less. They move less than the VIX index, right? So you're removing some of that noise. That can be good. I haven't used a ton of ATR, but I'm kind of currently examining it. So it's a great, if you're looking at the range of bars, historical bars, it can be very advantageous. I think who's it? J. Wells Wilder invented this in the 70s, right? So he had a book called New Concepts in Technical Analysis, and he developed like ADX, RSI, ATR. So I mean, some really good technical indicators that have withstood the test of time. So that's a great book to explore that. And I think ATR can work very well if you're looking at historical bars. The difference in my opinion is that volatility, since the VIX index is measuring implied volatility of options, it's a little more forward looking. If you're using ATR, it's really historical looking, and each can work well. So I think ATR can be a good tool in the toolbox, so to speak.
Yep. Okay, thank you. You actually just answered a question from Google user wanting to know, do you focus on implied volatility or realized volatility for intraday strategies? Did you have anything to add to that one?
No, I think it's just important to note that the VIX index is using implied volatility, right? So if market makers are sensing that there's a vol event, say an election or any type of market event in the market, the VIX term structure is going to increase, and the implied volatility is increasing that they're pricing into the options. So subsequently, the VIX index is going to increase. So that forward-looking implied volatility analysis, I think, is pretty important because just looking historically, you get some hindsight bias, and you might not be taking into account certain events that are coming up in the market. So I think VIX index really incorporates that.
Yeah. Okay, one more question from the chat before we move on. You've already touched on this a little bit, but maybe you can clarify a little bit further. So this one's from SL. Again, do you filter trades using its own volatility or volatility compared to overall market volatility as well?
Yeah, that's an interesting question. I haven't really used the volatility of the strategy as a filtering. I've typically looked more generally at the market volatility as a general measure. But yeah, I think that would be something very interesting to explore. I haven't looked at that, and
Okay.
could be pretty interesting.
Yeah. Okay. All right. Well, we might move on. There's a few more questions in the chat, which we'll save for a little bit later. So keep them coming. Got some great questions today. So I wanted to ask about, I guess, a common approach for getting exposure to volatility was to short VIX futures. Do you use that approach, and what do you think is the best way to get exposure to volatility?
So yeah, like I mentioned, a lot of the short VIX future sellers got wiped out in volmageddon. So you have to understand that that's a short volatility strategy. You can do it, but I think instead of just shorting the front month VIX futures, you can use calendar spreads in VIX futures. So you might short the second or third month and go long the fifth month, or you can short the back end of the curve, which is moving much less than the front end. Now, the front end, you're going to have higher roll yield, but there's also way more risk in that, right? So you just, like any other trading strategy, balancing greed and fear in the market and not getting too greedy. Short vol can be very good. I think there's better ways to trade volatility. You might want to look at trading VIX versus E-minis, right? Because that spread is about 80% correlated, inversely correlated, I should say. So you can pair trade those. Another way is to pair trade VIX futures against VSTOXX futures. VSTOXX futures is European volatility. So I think we've got a slide on this. Maybe you can pull up.
Oh, yeah, sure. Yep.
So as you can imagine, US volatility and European volatility is highly correlated, or to use the better term, is highly co-integrated, meaning that it's a mean reverting spread, right? Because you can have two correlated strategies that don't mean revert. So co-integration, although related to correlation, means that the spread is mean reverting. So here on this slide, you see VIX futures and VSTOXX futures, and you can tell how correlated and co-integrated the spread is, and the spread in the futures is in the green. So when you're looking at the spread, this is a great statistical arbitrage spread, right? Where you can create, say, a 20-day moving average of the spread, and then every time there's a 2 standard deviation move, trade the mean reversion of that spread. So I think the next slide shows an example of how a trading strategy could work in that. I think it's important to note that VStocks doesn't have a ton of liquidity, so this is definitely more of a prop trading or individual trading strategy. I don't think a lot of institutions really trade this, but it's a really unique trade. And here you can look at the moving average of the spread and the 2 standard deviation bars on the upside and downside. Now, if you had a strategy that just shorted when it hit the upper threshold and then closed out when it hit the moving average, and vice versa on the downside, it could be a really profitable way to trade VIX futures and be somewhat hedged, right?
Yeah, you're right. Let me just click that off. My apologies there. So you're talking a little bit there about when to trade mean reversion and momentum. Have you found in your research that one is better than another if you aren't able to monitor the spreads, as you just mentioned there? Like if you're using maybe a more simplistic approach like ATR or something like that, have you found mean reversion and momentum work better in high or low volatility regimes?
Yeah, so typically going back to that VIX VStock spread, you have to be able to hold through to when it comes back to the moving average, right? So if the spread blows out, typically in volatility environments, high volatility environments, the spreads will blow out more. So they underperform temporarily while the spreads blow out, but as long as you're position size correctly, you're going to catch that mean reversion and do well. But in general, mean reversion strategies are relatively short vol because of that blowing out of the spread. Momentum strategies typically have positive convexity. So what do I mean by that? Is that like with a linear change in the price, there's an exponential benefit of the strategy P&L, right? So as the market does worse and worse during March of 2020 or April of 2020, momentum strategies are catching those violent falls in the market, and you can outperform pretty significantly. So I view momentum strategies as essentially long vol strategies, and then other mean reverting strategies as more short vol or relative value strategies.
Okay, let's talk a little bit more about the VIX term structure as a regime filter. You've touched on it a little bit already, but can you explain a little bit more about how you apply that into your trading?
Yeah, so VIX term structure 80% of the time is in contango. So maybe you can pull up the slide of the term structure just so everyone understands the difference between contango and backwardation.
So next slide, isn't it? Here we go.
Yeah, so here's an example of contango where the VIX is at 15.57, and you see the VIX term structure is downward sloping, which means that as these futures approach expiration, you're going to get a positive roll yield by shorting the VIX future. And then the opposite with backwardation. So 80% of the time, the market's in contango, usually when there's low volatility. And then if you move to the backwardation slide, when VIX spikes, the term structure moves to backwardation where it's upward sloping, sorry. And so looking at the term structure, you might compare, say, where the second month VIX future is compared to maybe later in the term structure. But usually when the term structure is moving into backwardation, maybe that's a sell signal, right? And you don't always want to wait till it fully hits backwardation, but as the curve is flattening, your exit signal could be based on the VIX spot compared to the second month future. And when the ratio between that gets closer to 1, you might exit a strategy ahead of a huge market downturn, right? So that's one way you can trade it and incorporate VIX term. There's a lot of information in the VIX term structure. So there's so many different ways to look at different maturities and use that as a signal.
Yeah. So just on this slide here, so you just mentioned that you might want to compare, say, the second month there with something further back. How far back would you go? Because as you can see here, that it kind of goes flat after a while. So does that lose its relevance after a period of time?
Yeah, the back end of the curve really doesn't move much. I mean, the VIX is one of the only mean reverting asset classes out there, which creates this unique structure of the term structure. Most commodity term structures don't move from backwardation to contango in a mean reverting fashion, right? If we know the VIX spikes and we're in backwardation, we know eventually it's going to come back to contango. So that's a very unique aspect of VIX futures. But to your point, the back end of the VIX curve is not moving that much. The front end of the curve might be moving too much, and there might be too much noise. So really, I try to focus on second, third, fourth month VIX futures, because I think that's the right balance where there's some movement, but there's not too much noise in the term structure.
Right. So are you looking for a ratio between those three if you're doing second, third, and fourth, or how do you apply that algorithmically?
Yeah, exactly like you said. I use a ratio because you can use that ratio to tell you the VIX term structure is flattening and it's time to get out of a strategy, or it's coming back into contango and it's time to get into a strategy. So entries and exits can be based on that ratio, and typically it's a pretty strong signal to use that I found.
Yeah. Okay. So how would you adjust your entries and exits then if the regime changes?
Yeah, so it's interesting because we're moving into a more, during, call it 2013 to 2018, right? We were in an extremely low vol environment, and now more recently there was some, you had volmageddon in 2018, a lot of volatility in Q4 2018. You had COVID when VIX spiked up to 82, 83 in March. So I think going forward, as we've seen inflation above 5%, and I know there's a baseline effect there, measuring it off of the COVID lows, and the Fed's beating the drum on inflation's transitory. But look, consumers, when you go to the pump and you're buying food, consumers feel it. There's inflation out there. And the Fed doesn't really focus on it, or they just want to continue to pump the economy and make sure that we ride out any bumps in everything we're dealing with from an environment from COVID perspective. But I think there is going to be more volatility going forward. And as interest rates, if inflation is in fact not transitory and we see higher inflation, the Fed's going to be forced to raise rates. And, with zero interest rates for the past 15 years or however long it was, there's been a huge shift from fixed income into equities. And now we're going to see a reversion of that, and fund flows really can drive equity market volatility. If all that money shifts back, institutional investors, pension funds, sovereign wealth funds, if they start moving back into higher yielding fixed income securities, they're selling their equities, and those fund flows can drive future volatility. So I think going forward, we could be in an interesting market environment where there is more volatility. And you need to pay attention to some of the term structure and the VIX index when developing your strategies.
Yeah. So the term structure then you think will be the the major sign that things are changing there, or are you looking at other things as well?
No, I think the VIX term structure is probably the most important, right? Because if you're seeing that the term structure is not in steep contango, when we're in a very low vol environment, there was very steep contango in the term structure, right? And so there's information in that. Now, I think what you're going to see going forward is that you might not have that same roll yield and that same steepness in the term structure. It might be a little bit flatter. It might be moving around a little bit more. And also, it's important to look at some of the kinks in the term structure, because what that really represents is event risk in the future, right? So if some of the VIX futures at certain maturities are higher than the whole term structure, maybe there's an event there that you need to pay attention to. So use that information in the term structure in your trading. I think can be really helpful.
Okay. We might just go to some questions in the chat now. So here's one from Jeff. Thanks for the question, Jeff. Do you use volatility to trade opening range breakouts, such as futures at New York Open, currency futures at London Open, DAX Open, etc.?
So I do trade breakout strategies, but I don't use volatility in those strategies particularly. I use volatility more in mean reverting strategies, and then also asset rotation strategies. So if I'm looking at a strategy that might trade E-mini S&P 500 futures, treasury futures, and gold futures, you can use that VIX term structure to rotate out of equities and into treasuries or gold as a safe haven, right? If the VIX term structure starts to move into backwardation. So I found that to be the best. For opening range breakouts, I really don't use a ton of that. I actually, going back to ADX, I think ADX is a great technical indicator to use in momentum strategies, right? Because that's kind of evaluating how much momentum there is in the market. So more for mean reversion and asset rotation type strategies and less for momentum strategies.
Mm-hmm. Yeah. Okay. We got a question here from Neil. You've given us a couple of examples earlier about volatility exceeding or coming below particular thresholds, but what about regimes that are rising or falling, perhaps above or below some moving average?
Yeah. So like I said, if you look at historically different vol events, I've found that VIX tends to spike very quickly. And then it might come down gradually over time. So it's hard to catch that VIX spike all the time. I don't really use long vol strategies in that perspective where VIX is spiking, the term structure is moving into backwardation. So now I'm going to go long VIX because you can really get crushed when VIX collapses, right? Usually those VIX spikes are very small, are very short. And then over time, they can move back. I mean, if you look at VIX spiking to close to 85 in March of 2020, it's now back at 16, right? So we've had a long, 18-month environment, and there's been some spikes along the way, but it's been gradually declining, and it's really hard to catch those spikes. I use it more as a signal of when to get out of certain strategies that are short vol or have some type of beta market exposure, right? It's more about hedging that tail risk, getting out of the strategies that don't perform well during volatility environments.
Okay. A question here from Hitesh. This one was very early on in our discussion. Have you modeled volatility clusters?
So I haven't. I think using some machine learning classification could be incredibly interesting for modeling vol, because you can really create some distinct classifications and use that to create strategies for each of those classifications. Like, I mean, you've had Ernie Chan on the podcast. He puts out some great content, and he talks about how machine learning, it doesn't always work well in signal generation. You can use random forest and classification machine learning strategies to create markets and regimes and identify and alter your strategies that way. But that type of research, although it seems interesting and there's a lot of advances there, I don't think it's really been used in signal generation effectively. So volatility clustering could be very interesting to separate regimes.
Okay. Thanks, Kyle. A question here from Ola. Thanks for the question, Ola. Ola's a regular. How do you get historical information about the VIX term structure?
Yeah, so VIX Central, those charts that I pulled up, I think VIXCentral.com is a great source where it has all of the VIX term structure data out there. Now I trade on TradeStation, right? And I subscribe to the feeds to get all the futures data. Another source I think you can use is Quandl. So back when I was back testing strategies in R and Python, I would call from Quandl for most of their VIX futures data and incorporate that into my back tests. I think they may have changed it. It was free, but now I think they're charging for it. So, you can use that. I'm not sure how expensive it is, but VIX Central is a great resource as well. So you can go there and it shows the current term structure, or you can enter in a date and it'll show you the term structure from that date. It'll show you different volatility indexes, not just the VIX, but the medium term. I think it's VXM, and the short term VIX. So that's a great resource in my opinion.
Okay, here's one from Google user. Do you use any dark models with VIX to improve its predictability?
So I do not. I know Garch modeling, and that's generalized autoregressive conditional heteroscedasticity. So that's a mouthful there. Hence why we use the term Garch. It's used a lot in volatility forecasting. I rarely am forecasting anything. I'm using statistical analysis to understand how strategies behaved historically, and creating a diversified portfolio of strategies while being mindful of not overfitting. So how do you avoid overfitting is a good question. I only use a couple parameters. I use walk forward analysis to change the in sample and out of sample period for my back tests. And then most importantly, and probably the most simple method, is to change, if you change your parameters slightly, how much does this change the back test? If you're seeing huge swings and changes in the back test, it's probably not robust. So I don't use Garch modeling. I don't really use any forecasting. I'm not trying to forecast volatility. But I know when you talk to different quantitative investment management firms, that's used pretty heavily as a method. I'm really doing statistical analysis historically, creating diversified portfolios, and looking at the trading strategies from a portfolio theory perspective.
Yep. Okay. Thanks, Kyle. Here's a question from a trader in Brazil, Ronnie, I think it is. Ronnie, hey Ronnie, I'm a trader in Brazil. How do you manage your risk?
Yeah, great question. Because everyone has a different approach, right? So I manage risk by looking at historical backtest, and I'm really targeting a specific drawdown. And I trade futures, right? So I'm trading on margin, and you have enough leverage, to get in a lot of trouble with futures. So I'm creating strategies, combining them in a portfolio, and then trying to understand the drawdowns and the correlation of those strategies. Now, it's a great story to say, hey, we've got a bunch of uncorrelated strategies. We're going to put them in a portfolio and everything's going to work out nicely, right? And two strategies might have a zero correlation over the 10-year period you measure. Great. But if those strategies have a correlation of 1 during 2008, guess what? The diversification's not protecting you when you need it most. So you can't just look at long-term correlations. I like to look at rolling correlations. And then really, I just like to pick all the drawdowns and the volatility events and understand how the strategy's performed. Really examine the trades. When did it trade during the day? When did it hit the stop loss? And I look at daily data to understand the left tail in my back test, right? So what are the worst days in the back test and why? What happened on that day? So it's although I'm a quantitative and systematic trader, it's a less quantitative approach and a little bit more subjective of understanding your strategies intimately.
Yeah. You raise a good point actually about correlation measurement, because I see lots of traders that'll measure the correlation of strategies over, 5 or 10 years, and as you mentioned, it can be a very low number, but it's a rolling number, right? Depending on the regime. So how do you actually how do you measure that? Like, do you actually split out the regimes and then measure the correlations, or do you have like a a maximum and minimum, or what do you do to analyze the correlations if you're looking at a couple of strategies?
Yeah, typically I'm just, looking at the correlations on a rolling basis. So I'll put the returns, even it's just simple Excel work, right? Put the returns in Excel, look at the correlations and how they roll over time. And, if they move up significantly, what type of market environment is that in? And do you want to trade these strategies together in a portfolio if it's underperforming in a high vol environment, right? So, everyone uses correlation tables a lot, but you can really kind of fool yourself by using those, and just the law of averages, right, don't always hold up. You need other statistical analysis. So rolling correlations is one of them. At Algorithmic Futures, recently I just did a correlation analysis for a client of mine. He's trading a bunch of different systems, and he wanted to understand how Algorithmic Futures performs relative to his other systems. So I think he got a lot of insight from looking at the rolling correlations and seeing how the strategies perform.
Yeah. Okay, thanks for clarifying that. So we've got a question here from Mars Explorer. Love the name. What is the best indicator to measure volatility of a stock except for VIX?
Yeah, I mean, standard deviation is the standard measure, but it's not the best, right? Because if you look at ATR, you're really average true range. You're really looking at the historical bars and the range of those bars. So I think you can get a lot of good, robust signal out of that to understand on a daily, over the past 14 days, what is the average range of the bar been, and how is that going to affect your trading strategy, right? Are the bars really tight? Are we, are the open and close very far away, or the high and the low very far away, but we're closing at the middle of it? So, you have to look at bars from a path dependent perspective, not just after look where the close is and the open is. It's like, how did it move up and how did it move down during that bar? And I think average true range can be very helpful.
Okay.
And then one other thing I'll mention is that when you're doing analysis of portfolios, a lot of people like to use standard deviation and Sharpe ratio, which is return to standard deviation. But if you've got a Sharpe ratio that's being hurt by upside deviation, that doesn't make sense. I'll take upside deviation any day. Positive returns, high positive returns sound good to me, right? So you want to use Sortino ratio, which uses return to downside deviation, or Kalmar ratio, omega ratio, that's looking at the distribution of returns. There's a lot better metrics than Sharpe ratio, although Sharpe ratio is kind of like the industry standard for allocators, and it's very misleading.
Yep. Yeah, absolutely. All right, we got another question here from Jeff. Here we go, coming up. When do you decide to quit trading a specific strategy?
So I guess I would I'll answer that in two ways. If you're talking about when do I exit out of a strategy, is I trade always with take profits and stop losses, right? I create very structured trades, and going back to how do you manage risk, that's one way. When do I decide to quit trading a specific strategy? For example, if a strategy isn't working, usually I really haven't had any issues with, I do so much upfront research that when I create a portfolio, it's very rarely that I stop trading a strategy. I understand the periods it's not going to perform well in. And I think that's the best way to get comfort in your strategies, right? If you're just switching up your strategies or re-optimizing them every time you have a drawdown, it's kind of like playing whack-a-mole with every drawdown, right? That's not a way to develop robust portfolios, in my opinion. But occasionally, look, it happens, right? I mean, if the markets change significantly, or a regime changes that you didn't anticipate, you might just need to go back to the drawing board, examine the strategy, and be truthful with yourself and say, hey, I shouldn't be trading this anymore. It's not trading well in this market regime. Trading, you're graded every day with trading, right? So you got to be truthful with yourself and really examine your strategies.
Yeah. So a couple of minutes ago, we were talking about the current state of the environment and what could be happening with all the other, all these things going on outside of the markets. So what do you think traders should be doing to get prepared for anything that could possibly be coming in the future?
So I think history rhymes. It doesn't repeat, but it rhymes, right? So you want to look back at periods where we did have increasing inflation or where rates increased. If you're back testing over the past from like 2008 to current, you're really picking a specific market regime you're back testing your strategies on, and you might not be prepared for what's coming ahead. So if you look back to the 70s, that's a period where you had very high inflation and the Fed increased interest rates significantly. And what you had was, I think in 70 and 71, the market dropped 20%. And then in 73, 74, you had the oil embargo that caused significant inflation. Market was down 40%. And by the time you got to the end of the decade of the 1970s, real returns on equities were negative, right? So here is a high inflation, rising rate environment, and it could provide a glimpse into what we might see in the future. I'm not saying that's what we're going to see. We don't even know if inflation is going to be persistent, and so the Fed obviously doesn't. So it's helpful to look historically to see what type of volatility you might see in the market if inflation is increasing and rates are increasing. Because I'll tell you what, it's not going to look like the past 12 years or even from 2009 to 2018.
Right. So from a practical algorithmic point of view, how do you test that? Because I imagine data in the 1970s is pretty sparse, or accurate data anyway. So what can algorithmic traders do to get prepare their strategies?
You can use different stress testing. I think if you have the data, a lot of times when I'm using TradeStation data, equity index futures go back to 97, 98. So you're getting a longer testing period, right? So I think it's more about back testing throughout longer periods just to see how strategies will perform and behave. I'm not saying you want to optimize during that whole period, but it's more about examining it and looking at that. So other areas, you could use Monte Carlo simulation, stress testing in the portfolio, and those are also ways to look at the risk of your portfolio. But from an algorithmic trading perspective, back test and look at your back test during, I think we had, a little bit of inflation 2004 to 2006, right? So there's periods that if you have a longer back test period, it might provide some more insights.
Okay. All right. We'll ask one more question here from the chat, and then we'll start wrapping up for today. So here's a question from Ola. Thanks, Ola. What is your method of allocating funds between a set of strategies?
Yeah, that's a great question. And there's a lot of debate about this, right? Because essentially, if you're dynamically trading strategies, there's high probability you might be overfitting. So I think it's good to be cognizant of that. I personally, as I create a portfolio, I'm trading futures, right? So if I look at algorithmic futures portfolios, I might have a 50K portfolio that's trading 13 different strategies. Some of those are intraday, some of those are longer term, but I'm really trading only one contract per strategy. So I can't really, if you're trading smaller account sizes, you can't get too complex with allocating or increasing contract sizes for strategies. And I'm also fine with that because sometimes a simpler approach of equal weighting strategies is a lot of times better, right? It's hard to predict when your strategies are going to outperform and underperform. So you can be completely fine just trading one lots on each strategy and keep it equal weighted. If you're going to look at optimizing between strategies or using dynamic position sizing, be cognizant of overfitting because now you're creating multiple layers of overfitting, right? So you can overfit your back test and strategy, overfit the portfolio. There's hidden risks to that. So a lot of times keeping it simple is best.
Yep. Okay. All right. Well, I did say that was the last question, but there's one more here I want to ask you, and then we will finish up, I promise. So let's put this one up here for SL. With trend following strategies and the market is trending up, do you prefer to trade when stock volatility is decreasing or increasing? Do you care if overall market volatility is high or low at that time?
So if you're trading a trend following strategy and the market is trending up, it is most likely that volatility is decreasing, right? Because you might have had a vol event, now it's trending up. And typically, like I said, you have violent down markets, but very low vol up markets. So I think you definitely want to see that. And that could be a good confirmation signal is, okay, VIX is declining. We've got a good trending market. Maybe you're using market moving average crossovers. Maybe you're looking at price action, but having a confirmation signal of volatility decreasing is probably a good enhancement to the strategy.
Yep. Okay. All right. Well, thanks for your time today, Kyle. How can people either get in touch with you or learn more from you? Where can they go?
Yeah, so people can check out my website, which is www.algorithmic-futures.com. And just note that there is a dash in there. And here's a lot of information on the trading systems that we offer our clients. And you can also email me at info@algorithmic-futures.com. Once again, there's a dash in between algorithmic and futures. So I urge people, please reach out. You have questions, you want to learn about the trading systems that we're offering. I'm glad to chat and always open to conversation.
Yeah. Okay. Great. Thanks for that. Because I can see in the chat there's a couple more questions that we didn't get time to address from, so for example, from Good Old Boys. So they can contact you via email or through the website, and it's good to hear that you're happy to answer more questions. So yeah, thanks very much for your time today, Kyle. Really enjoyed the discussion. Was there anything else you wanted to add before we finish up for today?
No, I had a lot of fun, and this was a great discussion. So I appreciate having me on the podcast, and I look forward to any listeners that do want to reach out and chat more.
Okay, excellent. We got a lot of good feedback in the chat, so let's have a look at a couple of thank you before we finish up. So here's one from SL. Thanks, Kyle. Thanks, Andrew. Jeff said, great conversation. Thanks for the questions today, Jeff. Here's a good one from Ola. Thanks for sharing your wealth of knowledge and experience. And thanks for another great session, Andrew. And Good Old Boy has some questions for you. I'll email you, but thanks so much for your time. And final one, this one's from Neil. Neil had some good questions. Thank you. Nice and simple. So yeah, it was great chatting to you today, Kyle, and appreciate the knowledge that you've shared with us. And I wish you all the best.
Yeah, thanks so much, Andrew. Take care.
All right, cheers. Thank you. Bye-bye. Cheers.